Hey everyone, Drew Creekmer here, Wealth Advisor with Creekmer Wealth. And in today's 5 Minute Finances, I want to dive into a topic that we've talked about a lot with clients and has a very important and large impact on your long-term finances and maybe something that you need to consider. And that is a Roth conversion. Now, I'm not going to dive into everything. There's a lot of ins and outs here. But at a high level overview, let's talk about why it's important to consider paying taxes on your retirement dollars now, today, and what that process looks like. And so up on my screen right now, I have the tax brackets from 2016 here on the left, and then the current tax brackets in 2021 here on the right. And what you'll notice when you're looking at the brackets on the left from 2016 is that first, our rates are different than the ones on the right. We have 10%, 15%, and 25% on down to 39.6. What you'll notice on the right is our rates are lower, 10, 12, 22, and 24%. Additionally, you'll notice that the income brackets at which those rates are taxed are wider. For example, for a single individual, in order for you to be in the 22% tax bracket, you're going to pay taxes of 22% on every dollar from $40,526 to $86,375. Whereas that would put you squarely in the 25% tax bracket. You'd be paying 25% income tax on every dollar you earn from $37,650 to $91,150. Obviously, that's a 3% higher tax back in 2016 and on more dollars than what you're paying today. And so what we're seeing a lot of folks say is, hey, I know that in 5 years, so in 2026, that'll be the last year when the tax brackets are going to expire that we currently have today, and they're going to revert back to this chart here on the left that we had before 2016. And so a lot of folks are saying, hey, can I pay taxes now on my retirement dollars that I have in my IRA account or that I'm contributing to my retirement plan, and go ahead and pay them now at lower rates than what I may pay them at in the future? Now, for everyone, that may be the right thing to do. That may not be. You need to meet with a trusted advisor to walk through your individual situation. But let's look at the impact of that. So I have a lot of clients who have money inside of an IRA account. And in their IRA account, they say, hey, you know what? I put this money in. I received an income tax deduction, or my earnings have not been taxed yet. So anytime money leaves an IRA account, you are going to pay income taxes on those dollars. And so you can either have that money come out of your IRA account now at lower tax rates and wider tax brackets, or you can have it come out in the future. And a lot of people say, you know what, when I turn 72 and I have to take what's called a required minimum distribution, an RMD, where the government forces you to take money out of your IRA, I don't want to do that, on top of not wanting to pay higher income taxes. So I'm going to go ahead and I'm going to convert some or all of my IRA account to an IRA. So what that looks like is you say, hey, I'm going to move X number of dollars from my IRA over to my Roth. And in the middle, I'm going to pay income taxes at whatever my current income tax rate is. If that's 22% and you move $10,000, you're going to pay taxes of $2,200. And now there are a number of ways that can be handled. Again, meet with a trusted advisor on how you would do that. However, by paying those taxes now on your contributions and earnings that you've not paid tax on in your IRA, you've gotten those dollars in a Roth where they can be invested and your earnings can grow with the knowledge that whenever you remove your contributions and earnings in the future, as long as you meet certain rules, you will not have to pay income tax on those dollars. And the government can't force you to take an RMD out of that Roth IRA. That's an incredibly powerful tool. And I think this chart here does a great job of showing the impact. Let's say you're a 60-year-old and you have $1 million right now in your 401k or in your IRA. Now, over the next number of years, you begin converting and paying taxes, this yellow line, on that balance. And so what we see here, the blue line is the value of your IRA over time. It stays pretty solid. Whereas this green line is the value of your Roth IRA. And as you notice, it continues increasing. That's because you're not being forced to take an RMD and pay taxes on those dollars. And so those dollars are able to be invested. Over time, your RMD will increase. That's this orange line. And your IRA balance will go down. However, by converting the amount that you can, and moving over to a Roth IRA, you're ensuring that your dollars are much more tax efficiently invested and you have greater control over those investments. So what I would encourage you to do is to take a look at your finances, see how much you're putting into your pre-tax 401k or 403b or your IRA, and think through, do I want to pay taxes now and contribute to a Roth IRA or a Roth 401k or 403b, or maybe even do a Roth conversion today at lower tax rates than what we know rates will be at in the future. This isn't right for everyone. However, I do have a great number of clients who are doing this strategy either all the way in and trying to move all of their dollars over to a Roth IRA or Roth account, or they're doing it with some of their dollars, depending upon what their individual situation looks like. So in a nutshell, that's the importance of income tax rates and brackets and the considerations that you need to have in mind when looking at doing a Roth conversion. If you have any questions, don't hesitate to reach out. There's many nuances to this topic. We would love to chat with you. We have a great team of advisors and financial planners who are available to walk you through the ins and outs of this conversation. Once again, thanks for the time, guys, and we look forward to talking with you soon. Have a good one.